Hello, good evening. Welcome to the webinar First Investment Property. I'm really sorry I late for several minutes, some technical issues, but right now I hope you can hear me well. This is seminar, webinar. You can use a chat if you need to ask any questions. So please stop me at any moment during my presentation. Feel free to ask your questions. I will make sure to check a chat every time and make sure to check if you will have any questions. So as usual, I start with a short disclaimer. Information is made available to you as a self-help tool for your independent use, not intended to provide personalized investment advice. So during today's presentation, we will mainly speak how to get investment property. And actually today's focus will be less on mortgages, more about investment property itself. So my main goal to help you to make educated decision about your first investment property. I'm doing this by following these rules. I will find a way. So I will find a way so you will eventually will get a mortgage. I will provide you with professional advice and you will instruct, so your client, you will instruct me, and the client's best interest are my priority. So I would like to start with a live real life example. And the reason that I want to jump to the example because I believe in our life and in real situation, real life example is exactly what we need in order to understand how to approach investment properties. Okay, so this example maybe not will suit to the area where you live, but a mess or how to approach any investment property will be the similar. So I'm taking this real life example and I will explain you why we pick this property as investment property and why it's a good investment. Okay, so let's say we have a 3-bedroom townhouse and the value of this townhouse $250,000. And down payment 20% was $50,000, so we took mortgage $200,000. And we got income for this property $1,700 monthly, and our payment for the mortgage $847 monthly. Okay, so this is a basic data that we need to know before we approach any investment situation. So we need to know what's the value of the property we can purchase, what will be down payment, what will be our mortgage, what will be income on this property, and what will be our monthly payments on this property, like what will be the mortgage. When we know this data, we can start our research and look how exactly we are approaching all calculation and what is the math behind all this investment. I'm just going to check quickly a chat, maybe some questions here. Okay, I don't see any questions, so we are good. So yeah, so again, if you have any questions, something unclear, please type your question in the chat and I will make sure to check it every time. So first of all, we want to know our income. If our income is just rental monthly income, so our income will be $1,700. If we have any other incomes, like we have a washer machine that takes coins or any other services that we are providing, so we should include this in the income. In this specific scenario, all income is just rental income. After we know our income, I want to calculate my expenses. So I start with the tax. So every property has a tax. This specific property has $180 monthly tax. Every property should be insured property. It's like fire insurance at least, or some kind of basic insurance. This property was insured for $70. Every property has utilities, so if it has gas, water, and any other things that you need to pay, in this case, residents pay for the utilities, so it's not expenses, so it's just zero. I need to take in account that this property will have some vacancies, that nobody will not occupy this property. As a standard, 5% from the rental income is a vacancy. So I'm calculating what is the 5% from $1,700, and it's $85. I need to put some money for repairs just in case if I need to repair something on the property. So it's approximately $100 on this type or this size of properties. Capital expenditure or CapEx, also $100. These expenses usually we want to put aside. It's in case if something going wrong. For example, you have TV on the property and it's broken, and you need to put a different TV or dishwasher machine or microwave. You need to replace it. So it's good to save every month $100 aside for this replacement. So in total repairs together with replacement $200, you can get or put aside a bigger amount, or you can put aside lower amount, and everyone decide how he is doing this. It depends by property itself, it depends by type of mortgage that you have. Like if you have, for example, advanceable mortgage, usually this money on your HELOC, so they going toward lowering your all total borrowing on your HELOC. So different mortgages, you can put this money so they will work for you, but you put it aside, okay? It's part of your expenses. If you manage this property on your own, and I believe if it's your first investment property, it's good to manage this property on your own, so you don't have any property managers there. And as I already said, mortgage itself is $847. So total monthly expenses $1,382. Maybe somebody wondering how I got number for mortgage. It's based on the amount borrowed, an amount of amortization of year, of interest rate that this specific family picked for their rental property. Again, it doesn't have to be $847. It can be a bigger amount of mortgage. It depends how fast you want to pay out this rental property. Usually people, when they take mortgages for rental properties, they not even take it 25 years. Sometimes they take 30 years or even longer period of time. So all this can be calculated when you approaching your first investment property, or even any other next investment property. So after we discussed our income and we discussed our expenses and calculated and put down these numbers, so the next step is calculate cash flow. What is the cash flow? It's basically what we left. So we have income, we have expenses, income minus expenses, what we left. So $1,700 minus $1,382, it's $318. This is our monthly cash flow. This is our income, and total income in a year, it will be $3,816. Somebody will say, oh, it's not really good income. Somebody may say, oh, it's very, very good income. Somebody sells it. But actually, cash flow is not really helping with making decision about first investment property. Is it worth to have it, or it's maybe not worth? Again, it depends by how you approach to your mortgage. Cash flow may be very important. So $300 cash flow is considered a good cash flow. Even lower cash flow like $200 can be acceptable. Of course, we never accept any negative cash flow. Cash flow always should be positive, otherwise it's not investment property, it's just waste of money, and this is not something that we will consider to invest in. Okay, so cash flow should be positive, And as I said, $300, it's relatively good number, and even lower number is still good number. So how I know is this $3,816 of income in the year is a good income? So I always should look on return on investment. Return on investment is basically something that say me, is it good investment or bad investment? Like for example, if I am taking my money and invest in market, I want to know what will happen in a year, in 2, in 3, in 5 years with the market. I everything will go and what return of my investment I will get. And some people say return on investment should be like 4%, 5%. Somebody say, no, it's too low. A return on investment should be at least 10%, otherwise it's not covering inflation. And as you know, we have a higher level of inflation in Canada. Again, it depends by person and it depends by his personal circumstances, and it also depends by his level of risk. Someone can go and invest his money in Bitcoin and feel confident. Someone can go and invest in GD or some secured deposit and even in safe account, and not in still maybe not really sure if he should put money in saving account. Okay, and as you know, in saving accounts you will not get to more than 2% on your investments. On some maybe secure deposits you can get around 3% for investment. So average usually with the banks it's come to 5, sometimes 7% on investments, and some more risky can give you 10 or more percent. So we want to know if this investment property, where is this investment property? Is it something like in saving account or is it too risky? We want to know where is our percent going. So I have my down payment, it's $50,000, and when I was purchasing this property, I paid $5,000 to close a deal. Okay, it cost me 2% from cost of the property itself. Again, this is a specific real life example for this specific family. In your case, your expenses or closing cost may be lower, can be higher, but you need to include this in your calculation. Now, in this specific situation, we never considered renovation because it was a good enough property, but maybe in your area, something that you buy for $250,000, you maybe need to put some money on renovation, so you need to add some money on renovation. So in my case, in this case, it's $50,000 was total investment. I will stop for just a second. I want to check if I have any questions. Okay, I don't see any questions here, so I can continue with presentation. Again, if anyone wants to ask questions, even after this presentation, you can leave your questions in the comments under this video. Okay, so now I want to calculate ROI. So how I calculate return on investment? I'm taking into account annual cash flow. So this money that I got, $3,816, and I'm dividing this on my total investment, $55,000. And multiply by 100, and I got almost 7%, 6.94%. So this property has return on investment 7% or 6.94%. Someone will say, oh, it's not good ROI. Someone can say, oh, it's perfect ROI. Again, it depends by personality. I can say, based on my experience, it's very good ROI. Why? Because you want that your investment will be secure, and you want that your investment will be with relatively low risk. So 7%, it's good. Of course, inflation right now is much more higher, but inflation will not be with us forever. So this type of ROI is very good. Again, if you believe if you will take $55,000 and you invest in the market and you can get return of this money much better, like I will say at least 10% or higher, it's much better to invest in the market if you know where to invest and to get return around 10%. But if you are going to invest in the market and you expect return in the year around 7%, I will say it's much more risky than to do with a real estate property, because what you have here, you have a real property, you have a land where is this property located, you pay insurance, so if something happened to this property, fire or another disaster, you will get money back. So your money secured. Okay? Now, sometimes maybe when you go online and you see people speaking about return on investment of property, and they're speaking about much higher percent, like 10% or higher return on investment. Usually they taken in consideration not just cash on cash or return on investment just based on cash flow, they also taken in account equity. If you remember, we took a mortgage on this property, so our tenants pay our mortgage. When they pay mortgage divided two parts. One part is interest, one going toward equity. The part that going towards the interest, at the end of the year when you fill out taxes, you can use it as your expenses. Okay, so please don't forget, when you fill out taxes, your interest during the year that you paid on your mortgage, that on investment property, is taxable. Now, equity. So you can work with a mortgage professional like myself, and you can calculate what amount was paid during the first year. Or you can use mortgage calculator if you want. So if we can calculate what amount was paid out, or what part equity was paid out from this current property, we can include this in ROI calculation. Please pay close attention how I am doing this. So annual home equity or principal paid from our mortgage was $4,154 for 1 year, for the first year. So I'm taking annual cash flow and I'm adding to annual cash flow home equity. So $3,816 plus $4,154, and I divide this again on my total investment, and what I see, ROI or return on investment that included home equity that was paid down by your tenants, it's actually much more higher, almost 14.5%. So 14.49% if we calculate exactly. So this is good, very good ROI that included equity. Of course, you can always find properties where you can get ROI with home equity even 20% or even higher. Again, it depends by many factors. One of them is how is your mortgage built, how much equity, how much payment from your mortgage going towards the equity, and every circumstances we can do different calculation. One more additional fact, and very important fact, it's not equity that growth, because people usually say, or most investor can usually say, any property that you buy eventually will be more expensive. So cost of the property or value of the property growing with the time. This calculation not included this. So this calculation based only on money that was going through the property only. So this ROI that included home equity is not included potential equity growing with the time. We know that in Canada, in average, we have at least 5-7% increase in prices of the housing. So if you purchase any property with the time, its equity will grow anyway. But I don't want to include this in my calculation because I want to make sure that I have a good investment. Even in case my property value will never increase, I still will have the same ROI from home equity. More than this calculation included just for 1 year. If I will take longer period of time, like 5 years or 10 years, and I will do total calculation, and I take in account that my cash flow will not change. Let's say next 10 years, I will never raise rent, but it will not, everyone understand it will. So with the years, probably rent will be more expensive, maybe mortgage will be more expensive, maybe mortgage will be even cheaper, but rent will never go down. Rent will go up. It's across all of Canada. It's across around all world. I never saw situations that somebody was living in the rent many years, and after many years his rent went down for the same property. No, for the same property rent usually going up. Okay, so without taking in account 5-10 years, just taking in account first year of investment, ROI with home equity 14.49%, and it was showing me that this type of investment was very good investment. I will stop a pause for a second. I will check if I have any questions. Okay, I don't have any questions, so I can continue. Yeah, so I started my presentation with a live example. I showed how any investor should calculate properly what will be return of investment, and now I want just shortly to speak about the mortgages itself. So a down payment should be around 20%, and it's your own resources, or part of this can be gifted. And usually when we are struggling to get 20% for down payment, so we can use our property to purchase another property, and usually we have two options: or home equity line of credit HELOC, or cash out refinance. So the best time to do this when you have a property and you approaching renewal. Why it's the best time? Because during the renewal period you can do whatever you want with your mortgage. You can transfer it to another lender, you can refinance, and you will never pay any penalties. If you have a variable rate mortgage, it's not a problem. You can even break your mortgage in the middle. Why it's not a problem? Because your penalty will be relatively low. But if you have a fixed rate mortgages, usually it's high level of penalties. So as a general recommendation, it's better to wait until renewal. However, if you work in with mortgage professional like myself, we can calculate how much you losing on penalties, and maybe it's worth to get another property. I saw many circumstances when somebody taking equity from one property, purchasing another property, and actually another property was so good. So basically using another property, this person was able to pay down his original mortgage on his own property, like his primary residence, much more faster. And it's many examples like this. I will not show these examples on this presentation, but I showed this on my previous presentations. You can go on my YouTube channel and look on, there are several examples like this. You need to make sure that you have a good credit profile. Please make sure that you check in your credit profile. The most easiest way to check it on TransUnion or Equifax. You can also get subscription for free through Borrow and get your reports on Equifax on Borrow. Very convenient way. On Credit Karma, you get the similar reports of TransUnion. Today, you can subscribe to TransUnion for free. You can subscribe for Equifax for free, and you can get reports there anytime day and check what is going on in your credit profile. So please use it. You don't need to pay for the service. Again, it's completely free. Of course, we need to have some income. One income will come from your investment property, and also your own income. If you just change your job, we need to wait 3 months until you will have full-time employment, not on probation. When you have income, it's very important that even if you buy investment property, we are doing mortgage stress test. Today, we are qualifying rate still 5.25. Please pay attention that today's interest rate on fixed rate mortgages increased. So if you will decide to take 4% interest rate on like fixed mortgage and plus 2, 4% plus 2, it will be 6%, so you will need to qualify on 6%. This is the reason why many investors still taking a variable rate mortgages for investment properties. Closing cost or closing fees, as you remember on example, can be around 2%. It's usually lawyer fees, appraisal, GST, PST, if applicable, land transfer tax, adjustments, property tax, and other. Okay, so before I'm starting to speak about the things to avoid during the process, I want to check maybe there are any questions. Okay, I don't see any questions. I believe today's seminar will be relatively short one. So things to avoid during the process. So one, take out other loans. Okay, so if you're taking out other loans, it can affect your overall purchase ability. So please don't take out other loans. Consult with mortgage professional. And don't carry credit card debts because it will increase your TDS. It's not good. So you will not pass stress test. Try not to use cash. Try to do more registered transactions. Use like checks or anything that can be recorded through the bank statements. Please don't fall behind on bills because it will affect your credit score. Don't max your credit cards. In general, try to use maximum 30% of total credit available. Otherwise, it can negatively affect your credit score. And if you know or plan to switch a job, please don't do this during the process. Do it before the process or after the process. Okay, so I want to complete this presentation. I want to give several maybe a minute to anyone who wants to ask question. And if I will not get any questions, I hope everything was clear. You know how to find me. It's really easy on Boris Sapozhnikov Mortgages through Facebook, Twitter, Instagram, or this YouTube channel. Yeah, you can comment and I will be in touch with you as soon as possible. And thank you very much for being with me this half hour and watching this presentation. Have a wonderful rest of your evening.